I'm Jared Johnson, and on this episode of the Stock Market Playbook, we've got Julian Komar from Germany, who trades U.S. stocks, has a really great, no-nonsense, practical approach to how he finds stocks that he thinks can move 50 to 100% in a short period of time. I love his approach. I think you're going to as well. We had a great discussion. I hope you enjoy. All right, Julian, thanks for joining us on the podcast. Happy to have you today. You're joining us all the way from
From Germany, Hamburg.
Hamburg, Germany. So it's getting late in the evening. I mean, is it like 9 or 10 o'clock at night for you?
No. It's 7:30 right now, so it's not so late in the evening. So we had some dinner a few minutes ago, and now we are recording this podcast. So everything's fine.
Perfect, excellent. Well, I'm glad you took some time. I appreciate you taking some time to talk to us today. I think we have some great topics to cover, but as always, for people hearing and seeing you the first time, tell me a little bit about yourself and tell my listeners kind of what got you into all this trading stuff. Where are you coming from on everything?
Yeah, sure. Yeah, thanks for having me, first of all. And yeah, so I'm a US growth and momentum trader. So I'm living in Germany, but I trade US and growth and momentum stocks for many years. So I'm 20 plus years in the market right now. And I'm coming very much also from the stock market side. So I discovered very early stocks for my trading career in Germany. Then I traded some European stocks. And then finally, I think so 15 years ago, I started out with US stocks. And I, of course, tried out several styles until I would say so 13 years ago, I focused completely on growth and momentum stocks. And yeah, today I'm a full-time trader. So I can spend all my time with trading, but also teaching people, helping people to grow, and helping people also to become more consistent and systematic in their trading. Yeah.
That is great. That is great. So trading your own money, teaching people kind of how you approach the market, and I'm assuming kind of helping people develop their own approach to trading as well.
Yeah, sure. I think this is really crucial. The most people that I teach, they trade their own approaches, so they already have a couple of years of experience, and I help them especially to become more consistent. A lot of them come from, what I call signal services or copy services. So they already have been in a couple of services before. And then usually they come to me and ask, okay, how can I become a little bit more systematic in my approach? And then I'm helping them on one side, of course, to find their own style. On the other side, they can also look at how I am doing things. And I'm a very systematic trader. So this is something which I learned many years ago, systematic in a way that, I repeat the same things over and over again. I usually start with a market, have a very deep look at my own market trend model to see if it's a great time to run my strategy or not. And then, walk my way to the stock market with stock screeners, looking for high potential stocks that can make very big moves in a short period of time. So my target is always I want to trade stocks that can make a move of 50 to 100% in just a couple of weeks. And then, of course, I have my rules in place so that I know exactly every day what I want to buy or when I have to sell a stock, what the position size is that I put on, what my risk is, etc. So that I really have, all the steps in place in my trading process to, at the end, have a very systematic look at the stock market and also have some reliability. I think it's so important when I speak with other traders, I see that over and over again, how often they are sitting in front of the screens and try to guess what they should do every day. And I think this is a total wrong way. Your goal as a trader has always to become an independent trader, in my opinion. Independent in the sense that you have to make your own decisions and you must be capable to do that without having the need of the opinion and guidance from other people. So this is always what I strive for when I teach people, because I think that's the only way how you can survive as a trader long term. Yeah.
That that is that is great. Two things. First of all, you speak English very well, and your English is so much better than my German. I don't think I speak German at all, which is so that's awesome. And thing number two, in your approach, are you going straight equities? Do you do anything with options? Are you trading options on some of these growth stocks, or you're just buying
Oh,
shares?
yeah. I'm just buying shares. So, and I see that very often. People come to me and they lose a lot of money with options. And then I have to say to them, hey, step on the brakes. The first question when people come with options to me, I always ask the same question. I said, why do you need the margin? I mean, there are definitely some option strategies that you can apply, which are, something different than what I do. But what I see very often is that traders trade normal stocks and they want to make more money faster. And that's why they use options. And this is very often a way how to lose money very quickly. I personally don't need that margin. And that's also the reason why I'm not trading options. I want to keep things very simple. This is important for me. And yeah, that's why I never really touch options, to be honest.
Gotcha, gotcha. So you like the growth momentum stocks? I mean, are you looking at? I mean, is a typical company like a smaller tech company, maybe a I don't know, $200 to $500 million market cap kind of a thing? Is that kind of in a or tell me about the types of companies that you like for your
Yeah,
strategy.
I'm totally open to almost every company. So for me, liquidity is the more important thing than market cap, to be honest. The stock must be liquid enough for me to buy in and out very quickly. So the most
What is
trade
that? What's that parameter? Are you looking for a volume of shares traded per day kind of a thing?
a volume multiplied with price. So the turnover in US dollar on a given day, that's crucial for me because today I think we have a lot of very liquid small cap stocks in the market trading, sometimes 50 million US dollar, 100 million US dollar per day. And that's for me much more important than price or market cap. I want liquidity, that's very important. And the typical companies that I trade are high potential companies. That's how I call them. These are usually mid cap, small cap companies. I like to trade companies with more than 1 billion market cap. I don't trade all the very small ones, but 1 billion up to whatever, right? It could be also trillions. I have no problem with that. But what is important for me, I'm following what I call a 360-degree approach. And this is really important for me. I start with the technicals because technicals are important for me to see what is the supply and the demand in the stock. What are the institutions doing? That means I'm usually buying stocks that already made a very strong momentum move. Everything what is less than 70% away from the 52-week low, that's how I measure the momentum, is absolutely uninteresting for me, or it's not relevant for me. So I usually trade stocks that already doubled or even tripled before. So and then when I spot them with my stock screeners, then I go to the next step and have a look at the growth, at the fundamentals, so at the sales and at the EPS growth. And I trade several different type of stocks. I trade, for example, typical CanSlim stocks. What William O'Neill is doing or did in the past. But I trade also what I call sales growers. These are not profitable companies, but growing their sales very quickly. And when I say quick, I want to see 20, 30, 40, 50, 100% year over year sales growth. And then I go to the next step and have a look at the story itself, because I think this is very often what attracts institutions. And I need the institutions behind me so that they can push the prices higher for me. I can't do that. So, and this is where I go very deep also into some of the stocks to see, okay, is there anything what attracts institutions? And with that, I don't mean very superficial things like, oh, this company is in data centers or this company has to do something with AI. I want to see a very clear catalyst, something like, just to give you an example, Hewlett Packard Enterprise, HPE. Of course, everybody knows how fast they are growing and they are in data centers, etc. But I'm going one level deeper and see, okay, wow, they are really, really fast growing in networking, for example. Networking inside data centers, etc. So, and then I also try to get a feeling, okay, is the company able to grow in the future with the same pace, yes or no? And then I also try to get a feeling, okay, is that a company that is, let's say in quotes, cheap, when it comes to the price to sales ratio, as an example. And, when I get a very good feeling about a company and it really checks all the criteria and all the criteria are fulfilled, then I get also confidence. And this is based on a lot of experience, and this is also based on a lot of backtesting research. I studied thousands of past big winners. I traded thousands of stocks over the last years. And, sometimes I'm able to catch a big winner, like, for example, Dell this year, which I was able to catch 130% up move, or SanDisk or MU. These are, the companies that I traded this year. But also last year, rare earth metal companies, they had no sales, they had no EPS, but they had a great story, and there was a lot of demand in those companies. And this is how I orientate myself. I want to make sure that a stock is able to move 50 to 100% in a few weeks. So, and yeah, that's what I'm mostly doing.
That is very interesting. And I mean, I think it's interesting to note that in the stock market, right, there's always kind of a handful of stocks in so many scenarios it will move a lot. SanDisk, like you mentioned, has gone crazy, and Dell has gone crazy, and some of these stocks. And they really represent a fairly small number of stocks that are available to be traded, right? I mean, a few percent, 3, 4, 5% of stocks are moving like crazy, and the rest are kind of just doing okay and or not doing okay, right? Doing terrible. So to find those few is certainly a fair bit of work. I mean, what would you say? I mean, are you spending the majority of your time kind of researching these stocks? I mean, do you find that like a scanner and some of the technical side of things, as far as liquidity and some of the fundamental metrics you look for, does that narrow it down enough that you can then start really reading and getting the real inside
Yeah.
scoop on the company?
Yeah. So, and that's why I said you need to be systematic, right? So the most traders, they are not very systematic. They don't know what they want to buy, and they don't know what to look for. I'm running the same scans since years. I do not vary them very much. Sometimes I tweak them here and there, but they are showing me the strongest stocks in the market, the stocks that already made the biggest moves, the stocks that are attracting all the money, and this is where I'm focusing on. And when I see that the stock made a big move, I ask myself, of course, why? And there is no big move in the market without a reason. Institutions are usually very deep in the stories, in the fundamentals. They are trying to buy positions over months and years. They have dozens of analysts who do the work for you,
Yeah.
and the footprints are what I can see, right? And I spent the most of the time researching. Definitely, I would say I spent 95% of my time researching, trying to find good ideas, and trying also to understand what institutions are seeing in a company that I don't see right now. So, and I have a lot of experience in that. And on one side, it's a systematic process. On the other side, I know already a lot of companies. I know what to look for, based on my experience and also on my research. And that's why, it does not take so much time for me. When I or my daily trading routine is not longer than 30 minutes to 1 hour. And I would say during the week, I spent maybe 2 to 3 hours doing research, etc. So I know exactly what I want to look for. And that is helping a lot to shorten the time you spend with the screens, or before the screens, right? So if you are systematic, if you're consistent, and what you said, a minute ago is totally right. I would say I'm ignoring 99.5% of all stocks in the market. You know, we have 10,000 stocks, and my usual or my normal watch list does not contain more than 50 stocks. And even from these 50 stocks, I maybe have a portfolio of 5 to 8 stocks, and that's it. You know, and this is, you know, being so selective, and also being systematic in looking at the market, sorting out candidates. I think it's the right way. And of course, that is something most traders don't want to hear. But that also means you ignore a lot of stocks that make moves anyway, right? So of course, there are also stocks which do not fit your criteria, but they are moving higher. So, and you have to say no to them, and that's totally fine, right?
Yeah, yeah. A good trading strategy certainly has a lot of no's in it. And
Yeah.
because it's so easy to chase a stock and to see something moving and to see a headline and see a lot of excitement around certain things. But I'm pretty interested, and I've been asking a lot of guests this lately because some only do this and some don't do this. But I love asking people, there's this interesting thought around buying the dip, right? And some
Hmm.
say the dip gets cheaper, and that's obviously not
Hmm.
good. And some only buy the dip, right? And it sounds like you're not into buying the dip. You want to see something. You said it needs to be at least 70% off above the 52-week low. So you're totally staying away from dips.
Yes. Yes, I mean, there are 1,000 ways of trading in the market, right? And it always comes back to your personality, what fits to you, what makes sense for your brain. I'm a breakout trader, so 95% of all my trades are breakouts. I never buy the dips. And the thing with buying the dip is what I have seen very often with traders that I work, it works one time, and then 3 or 4 times you get really punished. And this is, you know, when you buy a dip, that means you are buying against a short-term trend. And that can work if you are a professional trader with a lot of experience buying pullbacks, as an example. There's nothing wrong with that. It's not my way of trading. And there is a reason why I gave up pullback trading. The first of all, you know, I'm not good at that. So I probably need 1,000 hours or more to create the setup for me. And the second thing is a lot of pullbacks look very easy with a hindsight bias, right?
Yeah.
But if you trade them in real time, you have intraday volatility, and you also have stocks that go nowhere after you bought the pullback. So they are going sideways for many, many days. And they even sometimes continue to correct on the downside. Because if you buy a pullback, that means you are buying in a correction. You know, the stock is in a short-term downtrend. And that's what I'm not doing. But to be honest, you know, I personally think I could also make pullback work for me, but I need to put in a lot of hours. And I think it's better to have, you know, just a few setups than too many setups, you know, be a specialist and an expert in just a few setups, spend thousands of hours with that instead of trying to be the jack of all trades. Yeah.
I think that's such an important comment because specifically, we don't need to be the jack of all trades. It's too difficult. You can't be an expert in all. But I think it's also a very important comment to highlight that stop doing what you're not good at.
Yeah.
I know a lot of people, speaking on the option side of things, I know a lot of people that say, I love buying options. And that is so tough. I don't know many people, and I know a lot of traders, and I manage a hedge fund, and I know a lot of fund traders that buying options is so difficult. You have everything working against you in that point. And but people love to do it because there's this unlimited upside potential for less money and so on. And it's just so important. And I talk to people about this quite a bit as well. If you have a great strategy that you love and it stresses me out, I can't do it, even though it works and makes money for you and vice versa. And so like you've been saying, you have to find something that works with you, but also you got to do something you're good at, unless you're willing to put in the time to make yourself good at that thing. But don't do it on live money because that's that's an expensive lesson to learn.
Yeah, yeah. I see that very often in the one-on-one coachings that I have with traders and people that I mentor. One of the things that I always make sure is I want to build on their strength. I think that every trader has strength. Because every brain works differently, and
Sure.
you have made different experiences, etc. And this is something you need to build on. And I very often give them a hint. When something makes sense for you, when something feels very natural for you in trading, it's probably the right way also to go, as an experienced trader, of course, right? So, and when I look at my own trading, I it's a little bit like you said, I'm also not able to do pullback trades. Pullbacks make, for me, just for me, no sense, right? I'm somebody who buys in an uptrend when stocks are going higher. That makes sense for me. Buying something which is more valuable and gets more valuable. So, but that does not mean that pullback strategies are not working for other traders, because they can think totally different, right? And that's something I have seen very often when I work with traders. I work with traders who were extremely good in reading news. Another one was a developer. He was able to develop his own indicators, right? And these are the strengths you want to build on as a trader, because this is something which is part already of you, and you want to find a trading approach which fits into that, and then you can become successful. And what I see very often with traders is they try to be somebody else. They try to be me, they try to be another trader, and that is very often not working. And I've seen that also. That's why I also said that at the beginning. When people come to me or join my community, very often they already have been in several signal services. They tried to be somebody else, and they already made the experience that it's impossible. They skip a few trades.
Yeah.
They traded the trades from the signal services a little bit different. They had not so much conviction in that, etc. They got a different execution, whatever. And then very quickly trying to copy another trader is nothing else than a dead end. You will never reach the results that you want to do. And the only way how to do that is put in the work, try to find out who you are, what is compatible with you, and then on the other side also put in the work to make it work for you. That is hard work, and that's what a lot of traders don't want to do, right?
The
um,
hard work is always, it's always hard. I guess that's
it's
why it gets
uncomfortable.
the name. It's uncomfortable, that's for sure. No, that's great stuff. Now tell me, in one of these examples, just going back to, I actually had a Substack post recently, and this is why I've been asking some of my guests, and I asked you, and I said, buying the dip has not ever produced much good for me in my own style as well, because I do like some momentum and I need that momentum. But on the flip side of that, what so if you get into something that has been running, what is kind of the exit signal for you? I mean, do you go off numbers? Do you say, hey, this is now 400% off its 52-week lows, or a certain distance, or a certain time, or a certain profit target? How is that exit
Yeah,
formulated?
yeah. Good question. So I'm also very systematic and consistent with that. So I only have a few exit strategies that I always apply on stocks. So I use mainly moving averages as trading stops. So the stocks that I trade, they make very big moves in a couple of weeks to a couple of months. So that means I'm using the EMA 8 and EMA 21 as a trading stop. And I'm also letting the stock show me which moving average is the right one. By just looking at the stock, where does it find natural support, at the EMA 8 or EMA 21? And so that's one strategy that I'm using for exiting. The second one is I sell some into the strength, and I keep things very simple here. Every time when a stock is up 10% or more, I sell a little bit into the strength, 10% or 20% of my existing position, just to take some profits off the table, manage my risk in a better way. And then the last exit strategy that I'm using is a little bit more discretion, and it's very rare that I use them. I sell into the strength, the climax top. So when a stock is in an uptrend for several months, and then starts to accelerate on the upside, then I sell very often the whole position into strength. That's a little bit more an art, but I had some good experiences with that. But it's rare that I apply that. So I would say 80% of all my stocks are exited by trading stops. Yeah.
Gotcha. That's excellent. Now, so that's on the exit side of things, and you've talked about some of the entry criteria, and some of the metrics that you want to see, and so on. What I mean, what is the final entry? How are you structuring your entry? Let's say that your price to sales ratios are good, moves off of lows are good. Um, I mean,
Yeah.
how are you entering that stock?
Yeah, I'm a breakout trader. So I have several patterns that I trade, usually horizontal resistance. So when a stock makes a very big move and it goes through a consolidation, let's say of 3, 5, 8 weeks plus, so sometimes more, then builds a horizontal resistance line at a very important price level, and it goes through this level, then I'm buying into the stock. And I have several patterns that I'm using. So one is a normal breakout from a consolidation. The other one is I call big base breakouts. So that means a stock went sideways for several months, 6 months, something like that, and breaks out of a big base. Then I'm trading also gap ups when a stock makes a very big move. For example, on the earnings day, I get into that. And then I also trade what I call late gap entries. So after a gap, you have some consolidation, and then I enter the stock. And I'm entering them as soon as the buy trigger hits. So as soon as the stock breaks out, I buy a first position into the stock. So that means I buy 50% when it breaks out initially. And then I add to my position every 1 or 2% higher until I have my full position. That's usually in 3 parts that I reach my full position. And I'm doing that because, of course, as a breakout trader, you have a lot of fake breakouts. So that is part of the game. But when you scale into a position, you have the benefit of reducing this failure rate a little bit, especially from the risk side. So if a stock has a fair breakout, I usually don't have a full position on, and that means I'm able to reduce my risk on these losing trades. And to be transparent on that, I have a win rate of 30 to 40%. So that means the majority of all my trades are losers, right? But when I'm right on the stock, I'm very right. So that means my win-loss ratio is usually 5 to 7 depending on the year, and that sometimes means I have stocks where I make 10 times, 20 times, or even more my risk back with just one trade. And
Yeah.
it's not a style that it's suited for everyone, because you have some pretty good losing streaks. I had a losing streak, I think, this year of 27 losing trades in a row. That is something you have to overcome.
Yeah.
Inclusive break-even trades. But that's something you have to deal with, right? And risk management is absolutely important for that. Otherwise, you get killed, right? So, but that's how I enter trades. And I'm usually expecting that the next trade is probably a fair breakout or losing trade with my hit rate. Yeah.
Yeah. Yeah. It's I feel like it's been more and more, those that have been in the industry for a long time, which sounds like you have, and I have, I've been at it for 20 plus years, and I think everybody that has been at it for a long time understands that, a win-loss ratio is completely relative to the size of the wins and the size of the losses. I mean, some of the most successful, still my favorite story, one of my favorite stories is, oh my goodness, I'm having a Renaissance, the
Mhm.
first big quant fund, right? And they said, our win ratio is about 50%. And people were like blown away. They said, that's terrible. And of course, these guys went on to produce $100 billion in profits from their trades. And so, and I feel like and rightfully so, it's being talked about more and more. There's so many great strategies that have 30, 40, 50% win ratios. But if your wins are massive and your losses, are small in size, then that totally works. Now, you can't lose 60 or 70% of your trades and have an equal size of wins and
Yeah.
losses. That obviously doesn't work. And on that note, I mean, you're looking for a trade that, or for a stock that you think has potential of a 50 to 100% move. I mean, what's a typical stop for you look like? How, like, percent based? Is it technically based? Are you putting it on the other side of a nearby support? How does that work typically?
Mm, I tend to get always tighter and tighter with my stops because I'm always optimizing this risk reward ratio. So typical stop is 3 to 5% for me. So that's what I'm usually placing. I usually place the stop loss below the breakout line or at the low of the day. And I think a lot of traders have a total wrong what is the right word, or they have a wrong opinion about the job of a stop loss. For me, the stop loss is something where I want to be out of a trade because the trade idea is invalid. It's not that I want to give the stock a lot of room or whatever. If the stock has a fair breakout, I'm out. It's very simple because the trading idea is invalid and I have to protect my capital. And it's not. I always get the impression that traders think, "Hey, stop losses. They want to hurt me," but at the end, it's the insurance, right? Stop loss and losing small is part of the expectancy and of the edge, right? If I would not lose small, I would not make any money, to be honest. And this is rather my thinking. Stop loss should be tight as possible. If I have to place a 7 or 10% stop loss, very often something is wrong. The stock's too volatile, the entry is not good enough. That's what I discovered. If I look at my own statistics, I can see that, the most profitable trades have a stop loss between 3 and 5%. That's what I can see. When my stop loss is getting too large, the most trades have a too high risk. It's not so profitable.
Yeah,
Yeah.
yeah, too much volatility, too wild of a ride. Now, do you in doing this? I mean, a typical kind of growth momentum stock is going to be fairly tech leaning,
Yeah.
right? You're going to be more in tech stocks. Um, are you agnostic to the stock you trade?
No, definitely not. Definitely not, because I'm doing a lot of research, so I'm not agnostic. I need to find something special for the stock in the stock in the company. And that also means I'm very much focused on tech. I have a tech background. I have been working in e-commerce for almost 20 years, I think, so a long time. I have a tech background and very good knowledge about technology, and that is also something I focus on. I have not much competence when it comes to, I don't know, biotech or oil and gas, etc. I can trade these stocks, based on technicals, and sometimes I find something very special. When I look, for example, at some oil machinery stocks, and then I found out how, okay, these companies are now power generating companies for data centers. This is something where I can see some potential in. But for me, that means I'm much focusing on tech because for a lot of industries are not suited for me, and I'm also not able to understand the potential in them. It's very difficult, if you have not really good knowledge about biotech companies and make very deep work with that. It's very hard to find the real high potential biotechs. It's the same with oil or gold stocks or whatever. So
Yeah, yeah, it is good staying in your sphere of competence because there's so many sectors out there that people don't understand and then they try to trade. I have a few colleagues that manage funds and they say, I stay out of tech. I don't ever trade tech. And I always think that's interesting because that has become such an important part of the stock market. I mean, tech stocks are such a massive part of the value of the stock market, and they certainly are huge movers. And I appreciate everybody has their approach, but so it's interesting, kind of. I mean, that's what makes the market, right? Some people only trade tech, and some people don't trade tech, and some people only trade
Yeah,
oil, and some people only trade, all the things that they trade. But um, I
yeah.
think that is great. Now, are you paying attention a lot to kind of the market narrative? I mean, does that influence your decisions? How do you feel about AI stocks? People are sick of talking about AI stocks. Are there still opportunities there?
I don't listen to other people, to be honest. I'm I'm um I'm paying attention to my process and to my scans. I'm a bottom up trader. So that means I try to find out what do the stocks have in common that pop up in my scans. And this is how I discover narratives like AI, for example, or software stocks. When I see a lot of software stocks popping up in my scans, probably money is rushing into software stocks. It's the same with semiconductors, etc. So, and this is how at the end, or at the end, how I discovered stocks. And I'm not reading any news. I'm also not interested in what Trump says, what the Fed is doing, whatever. I'm just listening to the market, to my market trend model, to my stock screeners, and I make decisions based on that. Because everything else, for me, it's just noise. It's just chatting. People love to chat about the market. They love to talk about the market, but that does not help them to make better decisions, because at the end you have to decide what you want to buy and where you want to put your money in, right? And I think it's better if you have some rules and if you have a clear process that you can repeat, and if you are very consistent in that. What you said a minute ago about the tech stocks, and some people don't trade tech stocks. Why not? I mean, I have somebody in my community. He's trading mostly gold stocks. Just gold stocks. He's so specialized in that. He knows everything about that. That's fine. And I think also sometimes people underestimate that they can leverage their own insights that they already have. If you are working, for example, in a data center, you know so much about data center companies probably that you can use that, and it's better to focus on that than trying to trade all the stocks at the same way. Yeah.
Yeah, yeah. There's too much to know, that's for sure. And so you do have to kind of be in that familiar spot. That's awesome. I mean, I think my listeners are going to have a lot to take away from this. I think this has been very interesting, and it's been very practical. I think there's just so many. Sometimes people need to be reminded that you don't have to overcomplicate. It's I find we all need permission to just keep it simple sometimes, and that's a great approach. So that's really cool. Tell my listeners where they can keep an eye on what you're doing and your continued journey in all of this.
Yeah, I think if you want to know more about me, you can go to my website, so juliankomar.com. You find me also on Twitter. I'm writing a lot of stuff for free on Twitter. I have a YouTube channel where you get also a lot of insights about my own trading and how I'm handling things. So I think these three things are the best to start with.
Excellent. Excellent. I think that's great. Okay. We'll make sure to include all those links in this episode as well. And thanks for being on with us. This was a great discussion. I think everybody's going to really love this one. So thanks for sharing and taking the time to be with us.
Yeah, thanks. Thank you very much for having me, Jared.
All right. Thanks. We'll stay in touch.
Cool. Thank you.